Good day, Market Chameleons, and everyone stopping by for the first time. Thanks for checking out the Market Chameleon live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. We'll be talking about screening for call spread opportunities using market IV leans. How you doing, D?
Good. How are you, Will?
Great. Let me share your screen, and let's roll.
So good morning, everyone, and well, just let me know if you see my screen because I'm using a different.
Yep, your screen's there. It's the
Okay.
You're on the landing page right now.
Yeah,
and it looks
so,
good. That landing page.
So first, let's navigate to the call spread screeners. Up top, you see these menus. We're gonna go to screeners. Let's click on bull call spread, and what we're gonna do is look for call spreads where the legs of the call spreads have trading activity, and there's a lean in that trading activity that may present an opportunity for better price execution, or maybe even an implied volatility opportunity. So we'll see what that looks like. And what we're going to do is, you see up top, we're on call spread screener right now. We have the filters above here that we could tab through, and we have the data elements below. And here you could see from left to right, we have the symbol, stock price, market cap. We have some statistics on theoretical values that we talked about yesterday. This identifies the spread, because when we look at call spreads, you're in this case, it's a bullish call spread. You're buying a call on one strike, selling a call on a higher strike, so it's a bullish call spread in the same expiration month. But there are lots of different combinations, right? You have different strikes, so you could create different combinations. There are different combinations of strikes, and you could do it on different expirations. So here you could see in NVIDIA right now, it's sorted by highest market cap. So we have all these different combinations. Here's November 21st, buying the 225 strikes on the 230 strike. In the same month, November 21st, you could do the 220 strike, buying 220 strikes on the 225 strike, and so on. You could even do the spread, the distance between strikes could be different. Here's a 202.5 strike versus a 205 strike, so there's 2.5 strike difference. Now, what we're going to do first is let's expand. Right now, we're defaulted to November 21st, but let's expand the number of spreads we're looking at, and I'm going to drop this down, and we're going to climb up here, and we're going to do any expirations that expire in the next 30 days. Okay, so when we click on that, it's going to bring us now different potential strike combinations, but also, if you'll see here, we have the November 21st, but here's an October 21st as well, November 7th, October 31st. So now we have different expirations and different strikes. And now we have 137,000 candidates in here. Right now, we're seeing all NVIDIA because it's the highest market cap, but if we tab through, you'll see other stocks in there. And we're going to go to a different tab here. We're going to click on volume analysis, okay? And the idea here is that while there are different combinations of strikes and expirations, sometimes there are options that have very little trading, maybe zero trades, and they may be wide. They may not have any open interest. So we could narrow down our search to see where there's actual trading activity And the idea there is that, well, if there's trading activity, there's a better opportunity to get executed at a better price, because now you have, trading interest that's coming in, where more market participants trying to negotiate prices gives you an opportunity to do that. And when there's trading interest or there's trading pressure, it could also push certain options to more favorable prices or values, right? So because trading pushes, that's what pushes values to different levels. So here we could see here in NVIDIA, I switched to tabs, and if we go from left to right, we have, again, stock price. This is the repeating the spread, so we know what we're looking at. November 21st, 225, 230 strike, and you can see all the way down the line. This is the market price, so this is just looking at the ask price that we're analyzing. And here it shows us the volume and open interest on each leg. So here's the buy strike. We see that there's 233 contracts traded on the 225 strike, and it has an open interest of 512. And the 230 strike, it has it traded 8,446 contracts with a large open interest, 23,928. So there is some trading activity with open interest, and now we see that there's trader interest in both those options. But we could also narrow this down. If I try to sort this, from high to low, I'm sure we're going to get some where there's very little. And when you click on that, this is going to resort. So you can see here, I clicked it. Here's symbol AA. We're looking at a November 7th, 333.37 spread, but there's zero volume in the 33 strike, 301 contracts on the 37 strike with small open interest. So this there may be opportunity, but we'd have to look further, but we see that there's not much going on. Let's do this. First, let's filter out where we see trading activity. So we're going to go up here, trading data. We're going to say on the buy call, so this is on this buy strike. We want to see, I'm going to drop this down. Let's say we need over 1,000 contracts, more than 1,000 contracts traded on the day. This gives us a good, so you see here, now it filtered out to 10,542. So this shows us, okay, there's 1,000 contracts traded on this buy side, but the sell side, sometimes it could be weak, only 25 contracts here, 24 here. So let's do the same thing on the sell side. On the sell call volume, we also need at least 1,000. So I'm going to click that. So let's see how much it goes down by. Right now we have 10,542 potential candidates. Now we have 4,500. I'm going to resort this back. Well, let's keep it on here for now. So now that we have this, another thing we could do is look for a lean in the market. And the lean in the market is when you have an option. Let's go to this market data, for example. So this market data tab, it shows us, here's the spread value. The spread is 56-cent bid, 67-cent offer. But you could see that, there are two, there's a bid and an offer in one of the calls. So this is the buy call, 72 cents bid, 80 cents bid. And in the other call, it's 13 cents bid, 16 cents offered, right? So there's a spread there, where market participants are willing to buy it and willing to sell it, and there's two different prices. And what could happen is when there's trading activity, well, there could be an imbalance where there are more sellers or more buyers. And when there's an imbalance, the markets could become competitive. And let's say there's more sellers, and this market starts to come in. 79 cents offer, 78 cents offer, 76 cents offer. So you could see where if there's competition on one side, it could be competition on both, where they both squeeze in, which could be good, or on one side, right? And what we want to do is look for potentially a squeeze or a lean on the side, at least on the side that we're trying to do the opposite, right? So if you're trying to buy something, you want to see where there's competition of selling, because it could create an opportunity for you to buy at a better price, right? And if you're trying to sell something, there's competition to buy. Well, that might be good for you because that allows you to sell at a potentially more favorable or higher price, right? So think of it this way: if you're in the market to buy a car, well, for you to have a buyer's market and get a good deal, you need a bigger supply, right? There's more cars for sale than there are people at this moment willing to buy them. That gives you negotiability, right? Or maybe you have a used car and you just want to sell it, right? And you don't need it anymore. Well, then you want a buyer's market where there's less inventory to sell and a higher demand to buy. Gives you an opportunity to sell it at a higher price. And so that, right? So that would make sense. So given that, I'm going to go back to this volume analysis. These are where the leans come in, the buy lean, sell lean, right? So I'm going to go here to the filters. So if we're looking at the buy strike, the strike that we want to buy, right? We want to buy an option, let's say, on this strike, 83. Well, then what are we looking for? To get a better price, we might want to look for a sell lean where there's competition to sell, because we want to buy it at a better price. So I'm going to click on that, and there's going to be a lean on the ask price. So this is going to look for leans on the ask price, where, on the option that right here is designated. So you see here, ask lean. But we might want to do the same thing on the other side. Well, now we're buying one option, we're going to be selling the other option. So what about this sell side? Well, we might want to find a buy bid lean. There's competition to buy. So maybe we could get where there's a competition on both sides, could create a good spread opportunity, right? So now you could see here, ask lean, bid, right? I'm going to go back to this summary for a second. And let's just sort by highest market cap again. Let's just see what so I'm going to resort all these. Let's do it. It's sorted by lows to highest. If you do it again, it'll go highest to lows. And it's going to show us some, spreads that fit that criteria. Here's one in Amazon, the 230, 235, November 21st. Here's one in Tesla, right? The 445, 450, October 24th. So if you click on this expiration, it'll actually just take you to the options chain. We could see how that looks. Okay, so I'm going to click on this. Let's do Tesla. Right. So here's Tesla, and what based on our filters, we should see on each of these legs over 1,000 contracts traded on the day. 445 call, October 21st, and 450 call, and then we should see a sell lean on one and a buy lean on the other. Okay, so let's click on October 24th. And let me know if this goes to the options chain. This is what I did differently. Tell me if you see Tesla's option chain. Will?
Yeah, sorry, it froze real quick. I do see Tesla's option chain.
Okay, so you guys see Tesla's options chain. So I clicked on I'm gonna click on this menu to minimize it, expand our screen. So this is how it looks. So remember, this is the October. It showed us what we were looking at. Buying the October 445 call, selling the October 24th 450 call. So let's find those on our options chain. So the calls are on this side, puts are on the right. So here's the 445 strike. This is the call, right? I'm gonna use the spread ideally. Okay, I'm gonna click this so it makes it easier. So the 445 call, we could see there's a 1220 bid, 1225 offer, 5 cents wide. So you could see the surrounding options are 10 cents wide. So something's going on, right? The strike below is 1330, 1340. The strike above 1115, 1125. This one's 5 cents wide. So there's some competition there, right? It's a squeeze. It looks like in the market. 21,000 contracts traded, so it's trading. And we could see here, based on implied volatilities, that if we look at the strike below, it's offered at 94.3 vol. The strike above it is offered at 94.1 vol. But this one is 93.7, below a better relative value, right? And on a relative basis, if you're trying to buy an option, and you're looking at it from an implied volatility with the surrounding data, then a lower implied volatility is better than paying a higher, right? So if we look at the two strikes around it, this looks like that it is below both of them. So this is an indication that there's a out of these 21,000 whatever's trading, right now there's an offer, there's a competition to sell. Well, what about the 450 strike? So this is going to the other one. We're selling the 450 strike, and this is, you could see 1020 bid offered at 1025. Again, if we look at the surrounding ones, this is 10 cents wide, 920, not 10. So 5 cents wide is better than 10 cents wide. It's tighter, right? It gives you more negotiability. Like, you have a squeezed in market, and we could see that it looks like this one is squeezing to the bid is starting to lean. Look at the option below, 93.5 vol bid, option above 93.7 vol bid, but this one is 94.2 vol bid, higher than both. So if you're selling something, you want to sell it at the highest possible price. Right? That just makes sense. If I'm a seller, I want to sell at the highest price. So the higher the bid, the better. If I'm buying something, the lower the offer, the better. So in this situation, you could see that we have these options trading, right, on their own. There's lots of market participants, but as a spread, this could, if you're looking for bullish spread, right, if that's what you're looking for, if it fits into your portfolio, bullish, then this could offer a certain opportunity to participate in potentially better price execution. We have tighter markets, better, the implied volatility leans gives you a better value, right? You're trying to buy one for lesser price, selling for a higher price. So this is a way to quickly use a screener to kind of look for those scenarios, those potential trading opportunities. You'd always have to go and dig deeper and do your further research, whatever you need to do with analyzing news and whatever else you do. But this is a way to narrow down at least options based on those parameters. Okay. So I'm going to stop right there. That's what I kind of wanted to go over today.
Yeah, that was great, D. Thanks for bringing that to the Chameleon community. This is the second to last webinar of the week. Hopefully we'll have one tomorrow morning on Friday. Everyone have a safe trading day. Great job, D.
Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you tomorrow.
We'll see you tomorrow, D. Thanks. All right, everyone. Thanks for joining another Market Chameleon webinar, screening for call spread opportunities using IV leans. It was a great job by Dimitri. Thanks, everyone, for joining. Remember, if you're following us on the social platforms, YouTube, thumbs up, always appreciates, helps the algorithm. Everyone else, remember to follow us on YouTube and like us on all the social platforms. If you're joining for the first time, you can always click on the free trial. That will give you a 7-day free trial, a great way to test all the tools that we talk about here on the webinar series. With that, have a great day. Stay safe out there, and we'll see you tomorrow. Have a great day. Bye-bye.